Hi, welcome to Volatility 411. My name is Russell Rhoads. I'm a professor at the Kelley School of Business at Indiana University. I'm going to deviate a little bit today and talk about how you can interpret VIX futures prices, spot VIX, and why that's important in 2023. Now, in Chicago, we're calling this the year of Jordan because it's 2023, but most market participants are really concerned about what's the Fed going to do next. And stock traders, not only what's the Fed going to do next, but what's that going to do to the equity markets? Well, we can use derivatives to get an idea of what the futures markets think is going to happen as far as risk-free rate goes from the FOMC at different meetings. But that doesn't necessarily tell us if there's risk in the stock market or not. Well, one of the ways that you can gauge risk in the stock market at a future date, months out in the future, is take a look at the VIX term structure, which is usually a pretty smooth curve moving higher through time. Well, if you take a look at the VIX term structure, for a good part of 2023, as we get later in the year, it starts to come down, which means there's lower volatility anticipated later in the year. And that actually coincides with the possibility of a rate cut. We also have a couple of bumps in the curve in late summer and early fall that indicate a bit of uncertainty around what the Fed may do next and how that's going to impact the equity markets. So everybody's still got rates on their minds in 2023. You can use interest rate futures to gauge what the market thinks, but VIX futures are going to give you an idea of how much risk people are associating with those various meetings throughout the rest of this year. So with that, I'm Russell Rhoads, and that's your Volatility 411.